Welcome to Business Talk, a global podcast series where we bring you closer to some of the world's most distinguished scholars and their impactful ideas. I'm Deepak, your host from India. We're truly delighted to welcome Dr. Su Jiang to Business Talk. Professor Jiang's academic journey reflects a deep and sustained engagement with the foundations of accounting and economics. From earning his BS at the University of Science and Technology of China to completing his PhD at the University of Minnesota, his path has been shaped by a commitment to understanding how financial systems function and evolve. Before joining Duke University's Fuqua School of Business as an associate professor of business administration, he contributed to the academic community at Carnegie Mellon University's Tepper School of Business. At the heart of Professor Chiang's work lies a central question: how do rules, regulations, and communication shape financial decision making? His research explores critical areas such as banking regulation, the design of optimal disclosure policies, and the economic consequences of accounting standards. He also examines the role of strategic communication in financial and institutional settings, an area that is increasingly relevant in today's complex economic landscape. His insights have been featured in some of the most prestigious journals, including the Journal of Accounting and Economics, Journal of Economic Theory, Management Science, and the Accounting Review. Beyond research, Professor Chiang is a dedicated educator, known for bringing clarity and rigor to the classroom. His excellence in teaching was recognized with the Master of Management Studies Excellence in Teaching Award in 2016. He is equally respected for his service to the academic community, having received multiple excellence in reviewing awards from the Journal of Accounting Research, along with the Referee of the Year Award in 2024. He also served on the editorial and advisory review board of the Accounting Review. In today's episode, we explore his fascinating research titled Dancing to the Fed's Tune: Earnings Announcement, Clustering and Analyst Forecast Informativeness around FOMC Meetings, where he uncovers how firms and analysts respond to the rims of monetary policy. Professor Chia, welcome to Business Talk. It is truly an honor to have you with us today.
Thank you very much. It's an honor to be here as well.
Thank you. Professor, your paper is titled Dancing to the Fed's Tune, which is very evocative metaphor. Could you walk us through the intellectual journey that led you and your co-authors to study how corporate earnings announcement and analyst forecast move in step with the Federal Open Market Committee meetings?
Yeah, sure. So the idea comes from just some sort of practice because we have been following companies conference calls for certain companies, and then we do realize that for some companies, I'm not going to name the names here, and then because usually they follow like a very consistent pattern, but sometimes they kind of delay their earnings calls, and we find these delays actually coincides with the dates of the FOMC meetings, and then we find this is kind of interesting, and we're going to see whether this is more general, and so we did analysis and we look at the literature. We find there is no literature talking about this, and so we decide to write a paper about this.
Professor, in the model you develop, both firms and analysts have reasons to prefer forecast after the FOMC announcement, but they also face delays cost. How does the strategic interaction between firms and analysts actually play out in practice? And what surprised you most when you formalize it in the model timeline from TO T3?
So I think the delay cost, for the firm and for the analyst, they have been documented in the literature. So there is a management science paper by Eric So, who is a professor at MIT, and co-authors. They basically find that if firms delay, usually the market is going to interpret it as bad news. And then for analysts, there are also studies showing that, and also based on interviews with analysts. So this is what is in practice, that if they delay their earnings forecast, and then they would not really be considered as good for their career, just, they're not doing that on a timely basis, and then their clients are not going to be happy because once the information event comes out, their clients wants to know, like, very quickly what it means, and then you better write a research notes including your analysis of events. So those are the costs that play in practice. So both of them, they actually face a cost. And then in terms of the model, what surprises most is those two parties, they could share the cost, because usually we will think like one side has all the bargaining power or the other side has all the bargaining power. But in this case, because it's in their mutual interest to actually to delay that until after the FOMC announcement. So it's kind of like I would not say collusion, but it's sort of like implicit agreement.
Professor, you rely heavily on patterns firms that follow rigid, rule-based earnings announcement schedules like the same cat weekends of the month. Why are these firms so crucial for your identification strategy? And what do they reveal about how exogenous macro timings can enhance or constrain information efficiency in capital markets?
Yeah. So this is a very good question. So the reason that we rely on pattern firms is because we want to document that firms delay their earnings announcements, but delay has to be relative to a benchmark. And how would you establish the benchmark? If a firm, let's say, just reports earnings every quarter on a random date, then even if you're suspicious that the firm delays the earnings announcements, you cannot say that they're delaying announcement, because they can just say we report earnings on random dates. For firms that follow this pattern, then you would expect, or actually the investor, the market is going to expect, they're going to report earnings on this particular date. And so if they're not reporting on that date, then it's considered delayed. And then in terms of exogenous macro timing, how can I enhance or constrain information efficiency? So I think one of the message we want to say is those macro timing, they could actually change information efficiency in capital markets. So by forcing the firm and analysts to delay their earnings announcement or earnings forecast, they could generate some sort of like information vacuum shortly before the FOMC announcement. They would generate a surplus of information after the FOMC announcement.
Professor, the paper argues that FOMC meetings provide firm-relevant macro information which improves analyst forecast accuracy, especially for high beta and large firms. Can you unpack the main channels through which monetary policy surprises and the FedEx projections feed into micro-level earnings forecast?
Yeah, sure. So in terms of academia and also in practice, based on interviews with analysts, the literature basically documents that the firm's earnings has three components: the macroeconomic component, the industry component, and the firm's specific components. And so the monetary policy surprises would have a big impact on the macro components. And then, how large is the macro component relative to firm specific component? That really depends on what kind of firms we're talking about. And then for firms with high beta and large firms, their earnings or their cash flow tend to co-move with the general markets a lot. And because general market is affected by monetary policy, because monetary policy affects the discount rate that firms use to discount their cash flow, and for investors to discount their cash flow. That's why the market is going to respond strongly to monetary policy surprises. And for firms with earnings and cash flow that can move strongly with the markets, it will be important for them as well.
Professor, you find that when earnings announcement occur after FOMC meetings, analyst forecasts are more accurate, bid-ask spreads are lower, and investment becomes more sensitive to Tobin skew. How should we think about this chain from more informative forecast to better real investment decisions? Are firms learning more from prices, from analysts, or both?
And so in this paper, what we're arguing is that the firms is learning from analysts because there are literature showing that analysts are better than firms in uh, processing macro-specific information. Firms, they're better at processing firm-specific information. So in this case, when analysts provide more accurate forecasts, firms can glean from those forecasts about the macroeconomic information. And so there are literature basically showing that the firms they could learn from prices, the so-called feedback effect literature. In this paper, we're not really talking about that. In this paper, the bid-ask spreads are lower and investment becomes more sensitive to Tobin's Q. Just means that the market prices also become more informative. But market prices become more informative also because market participants learn from analysts. So in this case, it's both firm and the market learns from the analyst. And so the firm's investment decision becomes more efficient and the market price becomes more informative.
Professor, one of your key empirical results is the clustering of earnings announcement in a window around FOMC dates, with fewer announcements just before and a surge around and after the meeting. What does this clustering pattern tell us about how seriously firms take the macro calendar when deciding when to speak to the market?
I would think that, based on our findings, the firms, they take the macro calendar very seriously. We actually we try to conduct a survey for the firms in our sample, which we have documented have delayed their earnings announcements, even though no firm explicitly stated that for obvious reasons, because they don't really want their investors to think that they're strategically timing their earnings announcement. But some implicitly stated that the macro announcement is very important to them, and they would certainly take that into consideration when deciding their information releases.
Professor, your model suggests that firms and analysts share delay costs when shifting announcement closer to FOMC dates. And you show that analysts sometimes absorb this cost by delaying their own forecast. How do you interpret this cost sharing in terms of incentives and bargaining power between managers and sell side analysts?
Yeah, as we talked in your like second question about the surprising part of the model. So what is surprising is the firm analysts they both share the cost of delaying because it's mutually beneficial for them. And so the I would interpret this cost sharing in terms of incentive is just like firms having incentive to delay because they would learn from the analysts. The analysts would have incentive to delay because it would increase their forecast accuracy, would be good for their reputation, for their career. In terms of bargaining powers, so this is actually a good question. We haven't really addressed like how long do they delay? We're just saying they're delayed. But my conjecture would be if managers have more bargaining power, they would probably delay less, and the managers have less bargaining power, they will probably delay more. And those bargaining power really depends on, for example, how many analysts are following the firm. If you got, let's say, big firms like Microsoft, where you have, let's say, 43 analysts, I'm just making up that number, but it just means there are lots analysts are covering that firm, then the manager will have a lot of bargaining power. Whereas your firm is not covered by many analysts, and some of the analysts they're star analysts, and so then the analysts might have more bargaining power.
Professor, the paper documents that the benefits from FOMC information and changes in analyst behavior are stronger during periods of high economic policy uncertainty. How does heightened uncertainty change the way analysts and firms use central bank communication, and what does this imply for markets in turbulent times?
Yeah, so when economic policy is highly uncertain, so this is the time when nobody really knows what is going on, and so they're relying on some sort of guidance from the important players in the economy. The Federal Reserve is clearly one of the important players in the economy. So when economic policy uncertainty is high, then the Federal Reserve policy is even more important. So for example, if let's say we're facing uncertainty, we don't really know where the economy is headed. If the Federal Reserve says we're not going to increase the interest rate, we're going to keep interest rate at this level, or we're going to reduce the rate. That would speak a lot for the firm about the Fed's conjecture, about their projection of the macroeconomy, and so we shed more light. Whereas if there is not much uncertainty, then let's say we pretty much know what the economy is going on, then the value of the Federal Reserve's projection or conjecture is going to be less. And then, in terms of how this implied for markets in turbulent times just means that when markets are in turbulent times, people want more guidance from important players in the macroeconomy, and the Federal Reserve is one of the most important players in the macroeconomy.
Professor, you find that FOMC meetings and non-farm payroll employment reports both significantly improve analyst forecast accuracy, with payroll having an even larger impact, while FOMC minutes appear less informative. What does this comparison tell us about which kind of macro announcement analysts truly care about, and why the minutes are relatively muted?
Yeah, this is a good question, and we're actually now doing more analysis about this. And so, in terms of macro announcements, it really depends on what macro announcement tell you more about the macroeconomy. And we're doing an additional analysis, reading more literature from the macroeconomics literature about what macro announcements would shed more light on the macroeconomy. And in terms of non-farm payroll, I'm not really surprised that they could have a stronger impact, because this directly tells you about the unemployment rates, and this unemployment rates is a very good predictor of what the economy is heading. Whereas for FOMC meetings, it talks about monetary policy, and it is really the surprise component of the monetary policy that drives the markets. And so even if there is a surprise, the monetary policy rate does not directly impact the economy, or not as much as the unemployment rates, because unemployment directly tells you whether the economy is doing well or not doing well. The monetary policy, which determines the interest rate, has indirect effects on the macroeconomy, and a lot of it depends on other stuff. And so that's why the FOMC meeting minutes are relatively muted. And so in terms of what kinds of a macro announcement they truly care about, we're still doing additional analysis. But of course, it's whatever macro announcements that would shed more light about macroeconomy, analysts will care about more.
Professor Jiang, I would like to conclude this episode with one last question. Your evidence suggests it is in firms' interest to incur some delay cost so that analysts can incorporate FOMC information into their forecast, improving information efficiency. If regulators or standard setters were listening to this conversation, what policy questions or potential reforms would you want them to consider around earning timing, disclosure rules, or macro calendar coordination?
Yeah, so in terms of policy implications, so for the Federal Reserve, their calendar pretty much predetermined. They meet every 6 weeks, so I'm not entirely sure they could change that. But it is possible that they could do some sort of coordination, because they could look at when big firms usually announce earnings. And in that case, maybe they can be a little more flexible in terms of their meeting schedule. And then, in terms of, if they cannot change the meeting schedule, about, what they would say. So, for example, the current Federal Reserve, Kevin Warsh, he is in favor of not saying much. So in that case, then maybe it would be beneficial for firms not to delay, because if you can already hear much from the Federal Reserve, then there's no point of delaying. In terms of earnings timing, so once the Federal Reserve sets its calendar, then the firm have the choice in terms of when they're going to announce earnings. And so in this case, it really depends on the regulator's objective. If your objective is to maximize the overall informativeness of earnings announcements, you don't really need to do anything, because firms they would naturally choose the timing that maximize the information contained in their earnings announcement and analyst forecast revisions. But if you're concerned about, more even distribution of the information, you don't really want, no information for some period, and that information comes out immediately. A lot of information comes out at this particular point of time because you may have retail investors that may subject to information overload problems. And in this case, you may want to monitor more closely about firms' earnings announcements. You may want to say, if you deviate from your usual calendar, you need to provide explanation of why you're delaying the calendar, something like that. That may have some sort of disciplinary effect on firms' timing decision.
Thank you, Professor Jiang, for sharing such rich insights into how firms and analysts dance to the Fed's tune and what that means for market and real investment decisions. Your work adds a powerful macro lens to the way we think about earnings, forecast, and information efficiency, and it has been a privilege to explore it with you on Business Talk. On behalf of all of us at Business Talk, it has been a pleasure hosting you, and we look forward to many more such meaningful discussions with you. Thank you so much.
Thank you very much for having me. I really enjoy the discussions and questions in this as well.